Imbalances, one of the most powerful concepts in trading, yet often misunderstood. I'm Wendell, your mentor from Spektrades, and in this video, I'll break down exactly how to identify and trade imbalances with precision. By the end of this lesson, you will understand why imbalances occur, how they impact price, and most importantly, how you can use them to your advantage. Let's get right into this video. So what are imbalances in the market? The definition of an imbalance, also known as a fair value gap or FVG, is that an imbalance occurs when price moves too aggressively, leaving a gap with little trading activity. Think of it as unfinished business, where price often returns to mitigate. As we can see here, this is a clean chart depiction of a FVG, also known as an imbalance. This is right here, we see one candlestick, and then we see that price leaves a gap in price action and leaves another candlestick right here. This gap right here, the market has to come back to fill that gap. That's when we see this candlestick right here push down lower and fills this gap completely to then rally back higher. This is what we call an imbalance right here, where price leaves a gap in price action and later comes back to mitigate it to return to opposing sides of liquidity. So where exactly do we spot them? They can be commonly found in areas of impulsive price movement, such as news events or trend continuations. As you can see here, this is an impulsive bullish move. Therefore, it left this imbalance right here where price has to come back and mitigate it before it goes back to higher prices. We can clearly see them on the higher time frames, such as the 4-hour, the daily, for stronger setups. Why exactly do smart money care about imbalances? Imbalances act as magnets for price, since institutions aim to fill inefficiencies. These zones often align with other key concepts, such as order blocks or liquidity zones. So as we can see here, after price gives us a sharp move higher right here in price leaves this imbalance, the institutions, they have to pull price lower to fill in these gaps right here. We cannot leave these gaps empty when we are trading. So the institutions, they have to pull price lower or higher, depends if we have a bullish fair value gap or a bearish fair value gap, to then fill in that fair value gap to then push price back higher. So this right here is our imbalance. Now let's keep going. Now let's go over how to trade imbalances step by step. So the first thing for trading imbalances is that we have to identify the imbalance zones. Look for impulsive price movement with a clear gap between the candles. That's number one. As you can see here, this was a impulsive bullish movement right here. Price pushed up in this impulsive bullish nature and then left this gap in price action. You may be like, why don't you pick the first imbalance? As you can see here, we have one imbalance and then a second imbalance. A major key is that we should always pick the recent imbalance, because if price pushed down all the way down here to mitigate this imbalance, the trend may change. So price always pick the recent imbalance that we see. We never want to pick all the way down here, except right here could be a good zone, also depend on how low price may come, right? But this right here may be like a returning type of trade, but this is just a continuation setup right here, where we see that price gives us a impulsive move, and then on that pullback, price mitigates this fair value gap to then rally back higher to clear this old high right here. So this is key right here to identify our imbalance zones. Then we should highlight the area from the wick of one candle to the body of the wick to the other. As you can see here, just like I marked up here, right? We're just gonna mark out the area as just one wick right here, the below wick, and then the higher wick. So this right here, this gap becomes our imbalance. This right here is also known as an imbalance. Also, this is another gap. This candle to this candle, and this also is an imbalance. This candle to this candle. Right here, we have another imbalance. From this candle to this candle also, we have multiple imbalances that occur. For number two, we combine with context. We align imbalances with liquidity zones or order blocks for high probability setups. Check for confluences on higher time frames for stronger trades. As you can see here, after price went lower and give us this liquidity sweep of this prior old lows, and then rally higher and give us this market structure shift, and then give us this impulsive move higher, leaving this fair value gap. After price clears and fills in this fair value gap, all we're looking for is for opposing sides of liquidity. Where is the opposing side of liquidity? We have these buy side highs right here, these old highs. So after price mitigates our fair value gap, price then rallies higher. This is what it means by combine the fair value gap with context. We know exactly where price is likely to pull towards to, this fair value gap, which acts as a magnet for price to return. So we can catch our entries right here. And we know our target, which is these buy side old highs right here perfectly. And then for our entry and risk management, we wait for price to revisit the imbalance zones, and then we enter with confirmations such as candlestick patterns, market structure shifts, or etc. And then we place our stop loss below or above the imbalance zones for safety. As you can see here, since we are in a market maker buy model, after we took liquidity from these old lows and then rally higher and give us this market structure shift and then this impulsive move higher, this right here is our fair value gap, this imbalance. Then we can just take our entry right here and place our stop loss below the fair value gap below this candlestick low right here, and we're just targeting buy side liquidity highs right here. This is a clear step-by-step way on how to trade imbalances, also known as fair value gap. I'm sure you guys are taking a screenshot or writing these step by step, because you can revisit this in the future and follow this step by step to see exactly if your imbalance follows this nature right here. Another type of fair value gaps that we have is called the inverted fair value gap. Our inverted fair value gap is a powerful fair value gap. So what exactly is a inverted fair value gap? An inverted fair value gap occurs when price moves into an imbalance but does not fill it completely. Instead, price rejects the zone, signaling strong institutional interest in the opposing direction. Why are they important? They indicate order flow, bias, and reveal where institutions are entering positions. They often act as continuation zones for price in trending markets. So some key characteristics, make sure you guys write all these down. They'll occur within a strong trend, bullish or bearish. The price partially fills the gap but leaves some imbalances unfilled. They act as a launch pad for the next impulsive move. As you can see here in this pattern right here, price pushed down lower and give us this impulsive move to the downside and left us this bearish fair value gap right here. So what we can expect, we were expecting for price to go back inside of this bearish fair value gap to mitigate it to continue the bearish trend. But we can see that price violate this bearish fair value gap right here and left. So this right here becomes a inverted fair value gap. It was once a bearish fair value gap, but once price violate through it and give us a market structure shift of these old highs right here, this now has become a bullish fair value gap. When price comes back down lower to revisit this fair value gap, price will mitigate it to then go to the opposing side of liquidity to continue this trend right here. So this is exactly how we use our inversion, our inverted fair value gap. We call it a inversion or inverted fair value gap, whichever one you want to call it. But this right here is how we trade it. We wait for price to violate a fair value gap first, and once that fair value gap has been violated, then we're gonna extend our box, place our entries right at the fair value gap open, and stop loss right at the low, and targeting opposing sides of liquidity. This is our inverted fair value gap. Now let's go over spotting and trading imbalances in real time. For our top-down analysis, make sure you start on the daily time frames to locate large invisible imbalances and also highlight impulsive moves where price have left the gaps. Make sure you always start from the higher time frames and then scale down to the lower time frames. Start from the daily and then scale down to the 4-hour to then develop your bias. Then we can zoom in for precision. Move down to the 4-hour or the 1-hour time frame to refine the imbalance zone. Mark the imbalance area with a rectangle and note its boundaries. Now let's follow our execution plan. We use a confirmation entry strategy such as a market structure shift or a candlestick pattern. Then we place our stop loss just beyond the imbalance zone and aim for a logical take profit target. Previous highs or lows depend on the liquidity pools. Then we look for confluences, such as is the key imbalance near an order block or a liquidity sweep or a key level. Then we check if price is returning to the imbalance after a strong move. As we can see here, price went down lower and gave us a liquidity sweep of these prior old lows and then rallied higher sharply and it gave us a market structure shift of these old highs. Then price left us this fair value gap right here, this imbalance, and right above this imbalance, price built all these internal range liquidity lows right here. All these old lows right here, price has to come back down to violate these old lows and then to tap inside of our 5-minute fair value gap to then rally back higher to then come and clear our buy side liquidity. So we place our trade right at the fair value gap open and stop loss right at the old low of the fair value gap. As you can see, this is the fair value gap candle. So we place our stop loss right at the fair value gap low, and then we rally higher to attack old highs. So this is the exact trading plan to spot and trade imbalances in real time. Now let's go on the charts and see multiple examples of imbalances in inverted imbalances. Now we are looking at Nasdaq on the 5-minute time frames. As you guys can see here, price had rallied higher and then built this Asian range consolidation zone right here. And then during the London session, price rallied higher and cleared the Asian highs right here, and then went lower and give us a full body breakup structure. Perfect. And on the pullback, right, on the pullback, what did price use? Price used our fair value gap right here. Price went higher and mitigate the 50% of this fair value gap before price went lower and give us a lower time frame breakup structure of these old lows to then rally back higher to retest this fair value gap to then push price lower violently. This right here was the fair value gap in a sell format. But after this trend was done right here, after price cleared these interrange lows and these old lows right here, price mitigated this other 5-minute fair value gap and then started rallying back higher. And after we got this interrange 5-minute breakup structure, what did price use to rally? Price pushed down lower once more, mitigated this 5-minute fair value gap, and then rally again. And then right here again, price pushed down lower, give us liquidity sweeps of these old lows to then give us a breakup structure of this old low. Then on this pullback, what do we see once more? We see another fair value gap being used. So the fair value gaps is just like the magnet of the markets. Whenever price leaves a fair value gap, just like right here, price left a fair value gap, came right back into it to then push price higher. Then to finally push price higher to come and clear all these Asian highs right here, price pushed down lower, filled in this fair value gap, mitigated it to then push price higher. And then we had this small fair value gap here on the 5 minutes to then push price lower again to then push price higher. But this is kind of like how our fair value gaps play in action. Price will just, if we have a fair value gap left, after a break of structure, right, after proper structure, price will then pull back, mitigate that fair value gap to then continue. Now let's look at more examples. Right here is another example. This is the example of our inverted fair value gap. As you can see here, price had pushed down lower, give us a liquidity sweep of these old lows, and then rally higher and give us a breakup structure of these prior old highs. Then price left these interrange lows right here, and just like I stated for our inverted fair value gap, after price violated through it, it was once a bearish fair value gap, but once price violated through it, it will now be a bullish fair value gap. So as you can see, price pushed down lower, mitigated this fair value gap to then rally back higher to attack opposing side of liquidity. Now let's scale down to the 1 minute time frames to see exactly how we would enter. Now on the 1 minute time frames, this is our 3 minute inversion fair value gap. All we have to do is just place our stop loss right at the old low of the fair value gap. As you can see, stop loss right at the old lows, and we're targeting opposing side of liquidity. This trade right here was a 1 to 2R. Let's just pull it back and just see exactly how this trade played out. As you can see, we're just gonna place our entry stop loss below the old low of the fair value gap right here, and we're just gonna play it out. Boom, price taps us in and extend higher. This is just a quick scalp right here for this inverted fair value gap. Now let's look at another example. And now for our final example, as you can see here, price rallied higher and gave us a liquidity sweep of these old highs right here. And then this old high right here rallied higher, but it respected this old high right here. This we'll call our failure swing. Then price pushed down lower, pushed back higher, mitigated this order block right here, and then put price violently lower and give us a displacement, leaving this 5 minute fair value gap right here. And then we have all these interrange lows, this old low and this final old low right here. So for us to take this trade, we just have to place our trade right at the fair value gap open and stop loss right at old highs. Now let me just bring it back and just see exactly how this fair value gap trade played out. You can see price taps us in, the first low gets hit, and price pushed down lower to clear our old low. So price just went higher, tap inside of our fair value gap. You can either place your entry either at the open or the 50%. If you don't want to miss your trade, always place your trade at the open, but if you want to be more risk adverse, place your trade at the 50%. Mind that you may miss some trades if you put it at the 50% of the fair value gap. If you are looking for more insights like this, make sure you check out the first link in the description for the free Spark trading community, where we are getting super active at and where me and my brother are sending daily analysis. So make sure you join the free Spark trading community, the first link in the description. Well, this is it for this video. I hope you guys gain a lot of value. I hope you guys like, subscribe, and comment down below any videos that you want me to do. This is it. Spektrades